Next one up here, the new tech bull market has begun, says Dan Ives.
Microsoft and Google. Joining us here at Post 9 today, Dan Ives, Wedbush Securities Analyst. Dan, it's great to have you back.
Great to be here.
Sounds like you think it's going to be all about spending and use cases, which are going to explode in the coming quarters, I guess, yes?
Yeah, to me, it's all about use cases. We right now have about 80 use cases for AI based on all of our survey work. 3 months ago, that was 15 to 20. And I think that's what we're seeing even in earnings. If you look at Palantir, you look at Microsoft,
Palantir, shout out.
Now it's the first, second derivative, and we believe the third and fourth are going to hit in 2024, which is why, in my opinion, the new tech bull market has begun.
Is that going to begin to manifest itself and ignite in some of the AWS reInvent events?
By the way, what's my feeling on the new tech bull market has begun? My opinion of that is absolutely. But it hasn't really begun now, though. Let's be quite clear. It began a year ago. The new tech bull market began a year ago when they all bottomed, they all started going up. Then we got the AI cycle, and now we've had huge reaccelerations of growth across so many different companies, the Metas, the Palantirs, and you can go off there, the Amazons. All those companies troughed out their growth rates late last year or toward the first quarter, second quarter of this year. The only one that really hasn't, that I can think of, that's a bigger tech company is Apple. And you could say Tesla, if you want to throw them in the tech category, which some people say, no, they're an automaker, so don't talk about them as tech, whatever, okay? But those are really the only two that I can think of off the top of my head that I'm like, oh yeah, their growth rates are really bad right now considering where they're usually at for those companies, right? Apple's usually a company you can kind of expect 5 to 10% type revenue growth from. Many times, Tesla's obviously, 30 to 50%. And so when those companies are under those growth rates, usually people are like, oh, what's going on there? But outside of that, honestly, yeah. And you think about the AI software side. We've heard from the Snowflake CEO. They said that it's going to take off in 2024. That's when you're really going to start to see a boost up in these numbers. So don't be surprised if AWS posts much stronger growth in 2024 versus 2023. Don't be surprised if Palantir reports much stronger growth in 2024 versus 2023. And companies like Snowflake report much better growth in 2024 than 2023. You could go across so many different companies out there. You're probably going to see much stronger growth for them on the software side if they are a play on true AI.
I think it's going to be front and center. You saw it with Nadella. I think now you're seeing with Jassy, AWS, Google clearly, Oracle going to be another one. I think that's the key from an install-based perspective. You look at Adobe, you look at...
I like Oracle, and I've thought about buying Oracle. It's just the problem with Oracle is really their balance sheet. And so if I was to buy Oracle, I would just have to make it a small position, almost like a spec position.
Oracle, you could Salesforce. And, of course, right now at the top of the mountain is, of course,
NVIDIA.
Microsoft. But you look at what AWS is doing. That's a huge monetization opportunity for them. And I believe right now that's the golden goose. That's what this is going after. And we think it's $1 trillion of spend over the next decade.
Oh, so hold on. So let's see. Wedbush Securities makes a market in the securities of Apple, Amazon, Alphabet, MongoDB, Meta, Microsoft, Palantir, and Zscaler.
What this is going after, and we think it's $1 trillion of spend over the next decade. It's going to hit the shores of tech.
Enterprise tech only or consumer tech too?
Well, I think enterprise is 8 to 10x the opportunity right now of consumer tech.
Yes.
Now, when you look at consumer tech, I think that ultimately is the latter part where we're going to really see the Googles, the Metas, the other from a consumer advertising perspective. But Sarah, right now, the use cases that we're seeing explode is an enterprise.
What are you seeing that others...
Yes, 100%. And when it comes to the consumer side, they're not really going to see it or necessarily pay for it, right? It's going to get to them through companies like Metas or the Googles or companies like that. But they're not really going to necessarily see it. And so it's really a lot of B2B type spend, just to be quite frank, or B2G type spend.
Are not seeing that have already seen the run up in these stocks so far this year and have said they've dominated. And if the rally is going to expand, we need to see more participation, not just from the tech stocks.
Sure. And I think for us being in Asia 2 weeks, we saw it front and center in terms of not just use cases, but what the suppliers are talking about. You look through the supply chain. I think it all starts with chips. And I think what we're really seeing is right now an underestimation of what the demand looks like from the chip sector and from software. And I think when you look at names like Microsoft, that first now is starting to see these use cases explode. Datadog, I think Palantir is sort of the golden child of AI. That is how it's all going to form. And in terms of, to Sarah's point, the next wave is going to be broader tech in terms of small, mid-cap. And I think right now, a lot of bears, they're coming out of hibernation mode. And I believe they go back in terms of what I view as just a tech that ultimately could be up 8 to 10% more going into year end.
I'm trying to understand this use case thing. I mean, all right.
Hold your horses. What did that man just say? What, in the flipping flapjacking?
10% more going into year. Go back in terms of what I view as just a tech that ultimately could be up 8 to 10% more going into year end.
Whoa. This man's basically talking about the Qs being up another 8 to 10%. There's like, what, 30-something trading days left in this year? Talk about a ripper rally onto a ripper rally. My gosh. Woo-wee.
Use case thing, though. I mean, all right, we co-pilots out there. We can get a sense for that. And then there's this idea that there are going to be a lot of other tools shared by the big players for smaller enterprises. But what are you talking about? Are you saying use cases from a lot of companies for their customers, or are you talking about Microsoft providing all sorts of stuff into the enterprise?
Yeah, it's use case. I think nail on the head. It's use cases for that companies we're talking to across verticals, from life sciences, pharmaceutical, financials, government, where they're now seeing the use cases, clear ROI. Now they're building it. Where are they building it? On Microsoft, on AWS, on Google, on GCP. And that's why what we're starting to see right now in earnings season is you're starting to see the next phase of that. It's not just NVIDIA. Now you're seeing Microsoft, Datadog, Palantir. I ultimately believe Snowflake, and I think many others, Salesforce included. And I think that's what we're going to be talking about. You've always talked about use cases. What are the use cases?
Yeah.
We've done a survey with, 670 enterprises. 80% of them said that they plan to aggressively spend on AI companies in 2024. We think it could be up to 8 to 10% of budgets from less than 1% today. That is really...
So what's going on? Is it the learning curve? Is it everybody sort of getting comfortable and understanding, again, the use case or how it can help them? I mean, and how long does that take?
Yeah, I think what's really happened is that the last 3 to 4 months, a lot of these companies, CIOs, they've kicked the tires, they've done the trials, they've done the beta periods. Now they look at it and be like, it's clear ROI. If I spend $1-2 million, I could get that back in the course of 2-3 months. So I think the ROI is there. It's board driven. And now it's not just hype. You're actually starting to see the use cases explode. And that's why it all starts with NVIDIA. Then it goes to Microsoft and all the hyperscale players. And that's why, to me, it's not just to call it 5-7 players. I think as we look out, you're going to have 15, 20, 25 players across software and chips participating.
Wow, interesting. Okay. Yeah, I'm definitely bullish on a lot of these tech companies over the coming years, but I will say I'm not as bullish as Dan Ives over the next, let's call 1.5 months left in the trading year. I mean, my gosh, 8 to 10%. What a move, folks. Well, howdy there, folks. Welcome into this three-piece, 3 videos up here for me to react to. Then we're going to get into this one. Tesla is the biggest AI play in the world. Cathie would have some big comments around Tesla, and it's very intriguing because I don't know if you guys are aware of this or not, but Tesla is not her biggest position in the ARK fund anymore. I thought that was very surprising. Actually, going into today, it was actually her 3rd biggest position. So right now, it's now up to her 2nd biggest position. But I thought that was intriguing because it used to be Tesla was always the biggest. And so I just thought that was interesting that now it's not, folks. So yeah, next one up here, Tesla. Tesla is the biggest AI play in the world. Let's hear Cathie Wood speak about Tesla as well as why has it gone down in terms of it's not her biggest position anymore. That should be interesting.
Very bullish on autonomy, vehicle autonomy, of ETF all around it, robotics and the like. What do you make of what's happened with Cruise?
Yes.
The shutdown of Cruise, at least the temporary suspension of it. Derek Khosrowshahi, who runs Uber, was on the broadcast last week. He said he doesn't think that autonomy, in terms of autonomous vehicles or robotaxis or the like, are a real thing for another 5 or 10 years. Meaning, and by the way, I think 5 or 10 years ago, he would have said 5 or 10 years ago, that was what,
so would Elon, yes.
And so here we are.
Yes.
So what, have you changed your view about that? No. I mean, you must have, because I imagine if we go get tape of a conversation that we all probably had 5 or 10 years ago, we probably said 5 or 10 years from now.
22, 23, right. 24. We actually delay ours by 1 year relative to Elon, so maybe it should be 2 years. But
Yeah, Cathie would thought we would already have robo-taxis and all this stuff by now. Let's just be quite clear about that. Okay, so, that's why, if you always heard me speak about Tesla stock, I've never banked in like the robo-taxi opportunity. It's a call option on Tesla, right? And that's where I think Cathie Wood's maybe a little misguided, and some people are very misguided. They've been running these projections for Tesla's, autonomous taxi network, and it's like, we'll see when we get there. You can't just like start throwing out numbers. Like, we don't know what that business is going to be. We don't know what the margin is going to be. We don't know what the profitability is going to be. The auto business, we can get a gauge on where likely margins will be, where volumes will be, average selling prices. You can run numbers. You can run projections on that. Robo-taxi, you can't run anything on that. You're just throwing darts at a dartboard. I'm going to assume they're going to make this margin. Nah, it doesn't work like that. Oh, I'm assuming it's going to start this year. Everybody's been wrong on this year after year after year after year. We keep pushing it out, right?
Here's where we've learned how important Tesla's proprietary data is. It's 5 million robots around the world. Cruise didn't have anything like that. It had hundreds. 5 million robots around the world collect data every day and send it back to Tesla.
Yes, 100%. And so for Tesla, it's about how do we use that data, right? And how do we make sure that data is helping us out in an immense way. It's one thing to have the data, but it's another thing to be able to apply that data and have it help you ultimately create the best autonomous taxi network in the world that ultimately is not just dramatically safer than humans, but is near perfection, because that's what the regulators are going to want to see. They're going to want to see near perfection in regards to this, to really have it take off, certainly around most big cities, big states, and around the world. That's what they're going to need to be
more corner
perfect.
cases, which means disengagements, accidents, information like that, than all the other companies in the world combined.
100%.
And I have to tell you, watching the breakthroughs in AI that we are seeing, they are astounding, the speed at which this is moving.
Right.
So it is interesting.
100%.
I think it's a data issue. Autonomous taxi platforms are the biggest AI.
It's not a data issue. It's a being able to use the data efficiently, and so you can have near perfection, right? Tesla's had so much data for a long time, but they haven't been able to use it enough to have their autonomous taxi network opportunity be there yet, right? It still keeps getting pushed out year after year after year. In self-driving vehicles, why can't they drive as good as a human? They still can, actually, right? I watch a lot of these videos, and obviously I have Teslas as well, and I know people that have. The system's still not to human level. Like a good human driver, that is, it probably drives better than some bad human drivers. But in terms of a good human driver, it's still not better. It still makes a lot of questionable decisions. It still acts, I would say, very, in certain situations, it acts very unhuman-like in terms of its driving ability, where it's like, oh my gosh, like, who's driving this, a grandma? So we got still progress to be made. And that's the main thing. We still got a lot of progress to make here.
Project in the world, and therefore
the last 5% is everything in driving. That's the thing. Like 95% is cake. It's the 5% of weird situations that you get into on the road, construction, this, that, right? Signs that don't make any damn sense, lines that aren't lining up. Those are the situations that's the hardest part, and that's what Tesla's really been trying to perfect over the last few years, and it's a difficult job.
Tesla is the
But you've sold Tesla shares, and it's it used to be the number one holding, I believe, in your ETF. It's now number 3. You've sold about 20 million shares.
Yes.
Why?
So, whenever it goes up, it was up about 150% relative to our other names, many of which had not moved. So we will always recycle that way, take profits. And I would also say, listening to Elon on the last conference call, he's very concerned about the economy, as we are.
Cathie, will I look outside 5 years from now and see GM and Ford EV?
I think they should have let her go a little longer. And that's one of the issues I think a lot of folks have had with Cathie Wood is, she has a super long-term time horizon she talks about, right? But then, she makes moves like that, and then she'll sell a bunch of Tesla shares, and people are like, what's going on here, right? And if we look, Tesla's not even close to being a 10% weight right now. It's actually 7%. So I can understand if she was like, well, it became so overweighted. We were, because basically I believe in this ETF, they've got to keep everything under a 10% weight. So I understand, like, if it went over 10%, she's like, oh, we got to sell for that reason. But right now, it's not even remotely close. That's 7% of the weight, right? And so I think that's something that frustrates a lot of individuals.
Everywhere.
It's very interesting to hear both of them pull back saying,
But do you think, with this new way, I think, I don't even know if we'll be talking about GM and Ford in 5 years.
What is interesting about the news that both of them are pulling back for profitability reasons, they can't be profitable in this space unless they scale. That's how this works.
It's a catch-22.
So it's catch-22, and their shareholder base is very internal combustion engine oriented, and they want their profits now, and they want their dividends now. And they don't want that kind of investment. So how are they going to do it? Losses.
Will they be able to?
I don't know. All I know is, back to the Tesla question, as they are pulling away, our market share expectations for Tesla go up.
Right.
You know, and so to answer the question, we sold as it was up 150% relative to everything else. We have not sold much since then. And it will, if we're right on this autonomous taxi opportunity, it will remain in the top 5 in our fund, in our flagship.
So we'll talk about market share in just a moment, which I think that was a really important point she just brought up in regards to market share. But, to answer his question, are we going to see, a ton of Ford and GM EVs flying around 5-10 years from now? I would say the probability of that is looking lower and lower and lower. They can't move these things. Ford tries to, throw a bunch of these EVs at the dealerships, and the dealerships can't move them. And so, and then if they're not investing in them much further because their shareholder base is mad and these stocks aren't performing, it's a mess, man. It's an absolute mess. And so, as I've always said, in regards to my opinion on this, you're going to see consolidation. You're going to see the weakest companies get bought out by still weak companies. That's what you're going to ultimately see. And I think that's going to play out over a 5-10 year span. I don't think it's something that plays out overnight. I think it's over the next 5-10 years, right? Because still, at the end of the day, there's more internal combustion engine vehicles sold on a yearly basis by far, right, in the United States than EVs. At some point, that flip's going to happen, right? And then, it's just going to be a slow grind lower and lower and lower for ultimately many of those companies, right? Now, in regards to market share, she brings up a phenomenal point there. Phenomenal point, and this is very important. If they're not going to have any competition really from the big players, the Fords and the GMs and the Volkswagens, the traditional makers, right? And many of the smaller EV players are likely, going to face bankruptcy or going to get close to it, right? Like the Lucids and, any of those other companies you want to throw in there, the Fiskars and all those other stocks, right? Rivian looks pretty well positioned, but they still got a lot of progress to make in regards to their financials, their income statement, right? I mean, damn, it gets even more bullish for Tesla's market share over the coming years. If you don't have the traditional guys who already are just, embarrassing themselves in that space, and the smaller players are looking at potential bankruptcy, it's a better situation than ever for Tesla for market share over this next 5 years. And so that's another thing to be kind of factored in there that I think is very important, folks. So, alrighty, next one up here. Now is the time to stay invested in equities. This says the head of private wealth management for Goldman Sachs.
On pace for their longest winning streak in about 2 years. My next guest says now's the time to stay invested in equities while also adding exposure to fixed income. Joining me now, Post 9, Sarah Nason-Tarajano of Goldman Sachs Private Wealth. Welcome. It's good to see you.
Thanks so much for having me.
All right, so you're positive on the markets because a lot of people are so negative. What are they missing?
Listen, I am positive on the markets. Obviously, we've got a lot going on from a geopolitical perspective, from a rate perspective. But, I run the global family office business at Goldman Sachs. And I think one thing to keep in mind is that we're working with clients who are long-term investors. Mm-hmm. We're not, working with clients who are answering to a board of directors or thinking.
And answering to clients that are high net worth. High net worth.
Sort of daily market, NAV moves. And therefore, if you can really think long term about the market, we were advising clients on this, kind of post-summer 10% correction. Anytime you see a correction close to 10% is when you want to be getting longer, especially when you are a long-term holder of equities, which our family office and private clients typically are.
The flip side of that is now that we've had this big rally in the span of a week. So how does that factor into the way I should be thinking? We've spoken.
These people have a very intelligent. You can understand why they got into Goldman Sachs private wealth. You got to have so much money to get in there, man. So much damn money. But you got to think to yourself, like, what's the perspective, right? The perspective's genius. We're going to own more of the world over time. And it doesn't matter what we're going through in cycles. We're going to own more of the world. We're going to own more of the world. We're going to own more of the world, right? And that's the perspective of those people in thinking even around generational wealth, right? thinking about their money when they're not here anymore, when they're dead, right? And where does it go, whether it's to the family line or whether it be to charities or all those different things, right? Very, very long-term investors in just understanding the economies will grow over time. We will be much more prosperous as a world in 20 years from now than we are today, and in 10 years from now than we are today, and in 30 years than we are today. I mean, can you imagine the level of wealth the world's going to have 100 years from now? It's going to make today look like a joke. You're going to understand, even if you're a person that is, let's call it, somebody in poverty, there's an argument to be made that you could be living better than somebody lived, 100 or 200 years ago, in terms of what you have access to versus what those people had access to. Like literally, you could be somebody in the middle class today, and you live wealthier than the person that had the most money in the world 150 years ago. Like what they had access to, their level of healthcare, their level of everything compared to what you have access to, it's night and day difference. Now imagine 100 years from now, they're going to be the rich people of 100 years from now. And we're going to look at the rich people of today and be like, wow, their life sucked, man. They didn't have much going on. And the same thing with the folks in the middle class and things like that. So people forget that, right? And they forget all the technology developments and how much better life can be nowadays versus 100 years ago, 200 years ago, 300 years ago. People always like to think like in a negative perspective about like times are worse now. No, believe me. If you went and lived in the prior periods, you'd be like, get me the hell out of this thing, okay? Get me the hell out of this thing. Like, what? We don't have this, we don't have this, we don't have this, we don't have this. I'm out. So trust me on that.
With your colleague, Tony Pasquarello, on numerous occasions, most recently suggested the path of least resistance was higher.
If you told me I could be the richest person in the world 100 years ago, but I had to switch from today, hell no, I wouldn't switch. Not even 50 years ago. You could tell me I could be the richest person in the world 50 years ago. Would I switch? Hell no. Like, I don't want to live in 50 years ago. I don't want to live in the 1970s. Come on, man.
Now what? We've had this pretty substantial move.
Yeah, look, I still think you've got the seasonality impact of November and December. We see corporate buybacks, $5 billion a day of corporate buybacks up until December 8th. And then, we've got potentially a perfect storm. I don't want to say it, thinking about, a soft landing. If we think the Fed is done, which I do, that's positive for equities, clearly. If we think inflation can stay under control, which I tend to think it can. If we think the economic data is strong, but not so strong, and, payroll and wages are sort of at the right place to keep things at a moderate growth level, then I think that positions us really well for equities.
Would you then say you want to move broadly from just mega cap tech? I mean, if you are, inflation is going to be lower than maybe people think, the economy is going to still be more resilient than people think. Does that make the case for some of these other cyclical areas or not? You're kind of shaking your head like you're not willing to kind of go that far yet.
I'm probably not willing to go that far yet. And I think it's more for us about just staying long index exposure in U.S. equities and really focusing, if you're going to do single stock work, on companies with strong balance sheet, durable earnings growth, stable margins. You have to keep in mind that even though, we don't think the Fed is going to hike again, we are in a rates higher for longer market, and we have to think about
that part right there was extremely important because it lets you know somebody that's the head of private wealth management at Goldman Sachs, how they think about the type of companies they want to invest in. Like, what type of qualities are they looking for in companies, right?
For us, about just staying long index exposure in U.S. equities and really focusing, if you're going to do single stock work, on companies with strong balance sheet.
Strong balance sheet.
Durable earnings growth.
Earnings
margins.
Growth.
You have to keep in mind that
earnings growth and stable margins. Those are the three main components that somebody like that is looking for in a company, right? So just understand that's why those sorts of companies perform so phenomenal over time, even if sometimes they look overvalued on a forward P basis. If you have stable margins, you have, EPS that's pretty consistently going up, and you got a strong balance sheet, people don't mind paying up for that. Even if they got to pay a forward P that's well above the market, they say, I want quality, and that's true quality at the end of the day, right?
No, we don't think the Fed is going to hike again. We are in a rates higher for longer market, and we have to think about that impact on equities, we still favor U.S. equities, by the way. U.S. preeminence is a big theme for us. Our investment strategy group has had a fantastic call on that. I continue to have that view. But I also think we don't have to be quite as precise if you're talking about clients that hold stocks for years and sometimes decades and generations. So it's okay.
So she talks there about being, almost like overweight U.S. equities, right? Being heavy U.S. equities and not so interested international. And my view is I will focus more international investing when I see a lot more innovative companies that are going to kill it in other markets. And I just haven't seen that. What I see is even in the developing economies, I see the U.S. companies going in and then dominating in those markets. And I just don't see nearly enough innovation coming out of other countries. You could say China maybe has innovation, but no one wants to invest in Chinese stocks. That's a borderline scam in regards to that whole situation. So no one really wants to invest in Chinese stocks. Look at almost every single Chinese stock. Trash. Look at almost every single one, from the biggest big dogs of Alibaba all the way down to the Neos. All of them have been nothing but trash. A few of them pumped in the hype cycle of 2020, 2021, and all of them straight down. And all of them are basically lower than where they went IPO at. Think about that for a moment. Even if they've been public 5, 10, 15 years, it doesn't matter. And so there's not a lot of innovation really happening in other countries. Europe, it's just not happening, man. And I don't see it happening anytime soon. India is going to be a huge growing market. It's going to become massive, but I think a lot of the U.S. companies are going to be the ones to benefit the most from that, just to be quite frank, other than the people that live in India. And as wealth grows over there over the next 20 to 30 years, which is going to be a very exciting time. But yeah, man, there's just not a lot happening outside the United States. So if you want to invest, you got to invest in U.S. companies. They're the ones that really run the world, and there's no signs that they're going to stop running the world, because it's just not getting beat by anybody international. If anything, they're becoming even more dominant, which is interesting.
Don't get the timing perfect.
But you're not willing to go say that, the Fed, having been our foe, so to speak, by this regime they've been on, is not yet your friend. They're not going to cut, because a lot of times you could say, well, we think the Fed's not only done, but they're going to cut, want to get ahead of that.
Yeah.
If the Fed, is the game in town that matters most, higher for longer still means it could be a challenge with rates elevated.
Yeah, look, I think, not quite our friend, but not our enemy either, is how I would put it. And I think what I would say about that is, our house view, which I agree with, is we're going to see cuts in Q4 2004. And so actually an interesting topic. We've been having a lot of conversations.
Did you hear that house view? I love the way they term everything at Goldman Sachs. It's such a Goldman Sachs, they might be getting their mojo back. They might be getting it back.
Clients about fixed income. As you can imagine, we have been super short duration. I mean, it's hard to compete with treasuries 6 months at 5.5%. But if you have the view that the Fed is not going to continue to hike and that actually we're going to cut in Q4 24, then you want to start thinking about extending your duration a little bit. And 3 to 5 years is where we sort of think that sweet spot is with clients. And one nice thing about our client base, particularly family offices, these guys are long private assets, they're long equity portfolios and portfolios that spit out cash dividends. So you don't have to rebalance to allocate new money. And that's, kind of a lot of freedom to take that new capital and think about adding a little duration to the portfolio.
Also,
that's something that doesn't get talked about enough in regards to dividend investing specifically, right? Think about it like this. You got a big dividend portfolio, which these people and these family offices have $50 million, $100 million, hundreds of millions of dollars, sometimes billions of dollars, right? And you own a bunch of different dividend stocks, and those dividend stocks are paying you out every 3 months, likely hundreds of thousands of dollars, if not millions of dollars of capital every 3 months. Every 3 months. And so all of a sudden you have hundreds of thousands of dollars of capital, or millions of dollars of capital, or depending upon how much you might have tens of millions of dollars of capital to then deploy every 3 months. Think about that for a moment, right? And that's one of the beauties of dividend investing that I think many times is probably a little overlooked.
Investors who are
the super high net worth individuals do not overlook it.
Billionaire investors, either family office money or hedge funds, private credit. is hot.
It's a big theme. And, one thing to keep in mind, so we published a global family office survey in 2023. We did the same survey in 21. Our clients are historically under-allocated to private credit. They have a 3% allocation to private credit. This is not surprising. There are a couple factors. Nice. We come out of an incredibly low interest rate environment for the last decade.
Yeah, why not be in stocks?
Right. Yeah. But U.S. taxpayers also have to pay ordinary income in private credit. But today, I actually think private credit is really interesting because you're looking at, double-digit returns, and you've got a client base that is quite overweight equities, private equity alternatives. I think there's a real space in the portfolio for private credit, particularly in direct lending. Those double-digit returns are still interesting after tax. You're higher on the cap stack. You typically have better covenants. There's a lot of things that make private credit interesting.
Talked a lot about that yesterday.
Yeah, we'll see. Sometimes that private credit money doesn't come back, right?